Welcome to Deloitte's Dbriefs webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled Keeping Up with the Changes and Case Sharing for APA and Withholding Tax Mitigation. My name is Arthur Chen and I am a tax partner based in Deloitte, Taiwan. I have the pleasure of hosting today's webcast. I have with me today Angel Lo and Craig Zhou as presenters. Angel is an international tax partner, and Craig is a transfer pricing tax director, both based in Deloitte, Taiwan. You may access our bio on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit them at any time in the QA box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. We will do our best to respond to your question during the presentation. On the other hand, mobile device users can view the slide and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 15 minutes. So here is the overview of the topic we will cover today. Our last geography update was done back in 2018, so it has been a while. So we will try to cover some of the changes that are of interest to MNEs doing business in Taiwan. We will start off our session by talking a little bit about the P2 status in Taiwan, followed by the treaty roundup. After that, we will have Craig share the APA BAPA status in Taiwan, despite Taiwan have a rather limited treaty network, as well as the local TP audit trend. We will also briefly touch on the newly introduced or updated tax incentives, followed by the introduction of capital gains relating to the land and buildings that might be triggered in the case of both direct and indirect share transfer. Last but not the least, as Taiwan is a jurisdiction known for having strict withholding tax regime, we will also share some different ways available to mitigate Taiwan withholding tax. And if time permits so, we will answer some questions. So without further ado, Angel, can you please go ahead and share with us the update with Pillar 2?
Thanks, Arthur, and thanks everyone for joining us today. I'll start with the heated topic, which is the Pillar 2 development in Taiwan. As you might be aware of, a couple of the countries have already passed QDMTT and However, Taiwan is a little bit behind. While the Ministry of Finance has not released a confirmed timeline for enacting QDMTT, IR, and UTPR, instead it decided to start with an increase of domestic alternative minimum tax, the AMT rates. The reason is that originally, the AMT rate is at 12%, which is obviously below the global minimum tax rate at 15%. Before going any further, just a quick background on how Taiwan AMT regime works. It was first introduced as a benchmark check to the income tax paid by taxpayers that enjoy certain tax incentives or exemption treatment. For example, capital gains from the qualified security trading is currently exempted. AMT regime basically makes sure that these taxpayers still pay a fair share of taxes despite the incentives or exemption treatment. Under the local AMT, the exempted income would be added back to the ordinary taxable income calculation, and after certain deduction and exemption, the basic tax will be computed. And this basic tax will then be compared with the income tax calculated under the ordinary income tax rules, and taxpayer will have to pay the higher of the two. So to some extent, Taiwan AMT serves the same purposes as the GMT for securing a reasonable level of taxes to be collected from the taxpayers. So in August 2024, as a short-term measure, the Ministry of Finance proposed to increase the MT rate to 15% for entities that are impacted by GMT in the hope of minimizing the impact of Pillar 2 on some of the domestic entities.
Right, Angel. But the local MT we have here is not equivalent to QDMTT under the Pillar 2 rule, right?
Yes, that's correct. So as the AMT mechanism is not the same as how effective tax rate is computed under GLOBE rule, this has not really substituted QDMTT rules. Instead, some of the financial institutions, which are often under the AMT regime, got hit with higher AMT rates now. So we are still waiting for the Ministry of Finance to speed up the agenda. And the expectation is to have a draft version of QDMTT by end of this year, followed by IR and lastly UTPR. And now we will switch gear to the treaty updates. As of now, Taiwan has only signed double taxation agreements, the DTAs, with 35 countries. The latest one is with Korea, which became effective back in December 2023 and came into operation since January 1st, 2024. Since then, we have started seeing clients taking advantage of the preferential tax rates under the DTA, such as interest and royalty rates at 10%. And in this regard, my colleague Craig will talk about the unilateral and bilateral agreements from TP perspective shortly. The other treaties that were signed since our last debrief session in 2018 were with Saudi Arabia and Czech Republic. The other potential DTA relief coming in is with the states. This is actually a topic that has been sitting on the table for long. And the most recent development is that the U.S. House of Representatives passed the U.S. Taiwan Expedited Double Tax Relief Act on January 15, 2025. Section 894A has been inserted into the U.S. Internal Revenue Code to provide treaty-like benefits. If this is passed in the Senate and signed by the President in the states, this new tax code section will come into effect once it is confirmed that Taiwan will provide reciprocal benefits. In addition, the bill authorizes the U.S. resident to negotiate and enter into a tax agreement with Taiwan based on the U.S. Model Income Tax Convention. So what does this mean for cross-border transaction between the U.S. and Taiwan? For inbound clients, currently, the withholding tax rate on dividend is 21%. Under the Double Tax Relief Act, the withholding tax will be reduced to 10 to 15% for dividends and 10% for interest and royalties, which is a significant reduction from the current rate. In the past, US-based clients might have a structure to indirectly hold a Taiwan entity to reduce tax burden on dividends. Now there could be a legal rationalization opportunity. And now back to you, Arthur.
Thank you, Angel. Since we have touched on the expanded treaty network, in the next section, we will go through the current status of APAs, both unilateral and bilateral, with the latter one only being possible with an applicable tax treaty in place. Craig, would you please?
Sure, Arthur. Good afternoon, everyone. In this section, I will share about the APA environment in Taiwan and some specific issues while applying for bilateral APA or BAPA. And later, I will share our experience for the very first Taiwan-Korea BAPA case. Currently, under domestic rules, the APA application threshold in Taiwan is not high. An applicant can apply APA if the total amount of the related party transaction is higher than 500 million NT dollars, which is around 50.2 million US dollars, or the annual amount of such transaction is higher than 200 million NT dollars, which is around 6 million US dollars. However, as you can see from this chart on the left-hand side, there had not been many applications in the past years, and the number of applications all stayed within the single digit. Based on our observations, there are two possible reasons why Taiwan companies do not want to apply for APA. First, Taiwan Tax Authority do not have sufficient experienced teams and manpower. So relatively speaking, it may take a long time for them to review APA cases. Second, from the company's perspectives, the cost of APA is relatively high. And if there are no sizable benefits, there is a lack of incentive for Taiwan companies to apply for APA. However, starting from 2015, as the district tax bureaus continue to strengthen its TP audit to secure tax revenue, coupled with the fact that Taiwan has concluded 7 tax treaties, including Japan. Since then, we have seen the number of unilateral and bilateral APA applications increase. You could see the bar chart on the left-hand side, which shows that except for during the COVID-19 pandemic in 2019 and 2020, there are at least 6 APA applications each year. Also, starting from 2021, around 75% of the applications have been bilateral APAs. Based on the current APA statistics, for unilateral APAs, the applicants are enterprises with the headquarters in South Korea, the Netherlands, Hong Kong, the United States, and Sweden. Among the BAPA cases, the main countries involved up until 2023 include Japan, the Netherlands, Switzerland, and Singapore. With the Korea and Taiwan Tax Treaty coming into effect in 2024, and many Korean companies have significant business operations in Taiwan, we could expect an increase in both APA and BAPA cases. Next slide, please. In this slide, we will talk about the opportunity and some keynotes, especially for APA applications in Taiwan. Recently, we learned from the Ministry of Finance, MOF, that some district tax bureaus have formed specialized teams specifically to handle APA cases. And the MOF itself has encouraged all district tax bureaus to promote APA cases. Based on our experience, there are 2 possible situations that may prompt Taiwanese companies to consider the applications for APA. The first situation is if an overseas related party encounters a TP audit. For example, when the Japanese headquarters faces a TP audit and realizes its Taiwanese related entity earns a higher profit level. Since Japan has an effective tax treaty with Taiwan, the Japanese headquarters with its Taiwan-related entity may consider applying for the Mutual Agreement Procedure (MAP) and BAPA. Second, if a multinational enterprise sets up a new or amended group TP policy, which has a downward impact on the profit level of the local Taiwan entities, it is also a good timing for them to apply for APA. As to the sector of the applicants, Taiwan is renowned as a vibrant technology island, with TSMC and other local and international semiconductor players in Taiwan. So, it is not surprising that semiconductor and the related electronic components companies have been the main applicants for APAs. In order to follow the foreign headquarters policy, that the policy is consistently applied globally and implemented locally, some consumer product companies have also applied for APA in Taiwan. There are a couple of things to keep in mind. First of all, in Taiwan, the APA should be submitted before the end of the first taxable year covered in the APA. We know that in some countries, the APA should be submitted before the first day of the first taxable year. Second, a pre-filing meeting is optional but recommended because, as we mentioned before, relatively speaking, Taiwanese tax authority do not have much experience in APA applications, so a pre-filing meeting will help them to understand the case and fact pattern beforehand. Last but not least, there is a one-year review period for unilateral APA applications, with a possible 6 months extension. However, it is not applicable for bilateral or multilateral APAs. Back to you, Arthur.
Thank you, Craig. Before we move on to the next section, let's take this opportunity to do our first polling question for today. The question is, has your company ever considered applying APA or BAPA in Taiwan? The answers are yes, no, or we are still taking a wait and see approach, and last, no interest or no need. And while we wait for the result to come up, Craig, as we touched on the topic earlier, with the government's effort to expand the network, the treaty network, we do see the trend of increasing number of BAPA applications. So based on your observation, from which jurisdictions are the enterprises that are more active in pursuing BAPA with Taiwan Tax Authority?
Right. Based on the statistics, given the Taiwan tax treaty with Korea just became effective in 2024, and the one with Japan became effective back in 2016 or 17, and to add to that, we have many multinational headquarters in these two countries that have subsidiary in Taiwan. So we do see more and more applications coming from Japan and Korea. And that's why we will share our BAPA experience for these two jurisdictions.
Okay, thank you, Craig. That makes sense. And here is our polling result. All of our audiences, only 2 have applied, APA. And I would say majority, in fact, more than 70% are, taking wait and see approach or no interest or no need to APA. Application is pretty much consistent with our public statistic earlier. So Craig, would you please share with us your experience with BAPA application for Japan and Korea?
Thanks, Arthur. Most bilateral APA cases in Taiwan are Taiwan-Japan BAPAs. In this slide, we will share different practice and viewpoints between Taiwan and the Japan tax authorities. First, in Taiwan, 5 district tax bureaus separately deal with APA cases, and MOF plays a supporting role. So, the BAPA experiences are slightly different among the 5 district tax bureaus that sometimes make Japanese tax authority confused at what directions or approaches Taiwan tax office would like to take. To address this issue, the Taiwan MOF recently conducted an internal section in order to alignment on technical matters and best practices. Regarding the tipping method, since Taiwan Tax Authority basically tests each type of transaction, so the tipping method that will be decided on the feature of each transaction. Taking intangibles related party transaction, for example, Taiwan Tax Authority prefer to use the CUT method, with a few cases use the profit-split method. From the Japanese side, the tax authority generally prefer to use TNMM, CPM in Taiwan. If both parties hold significant intangibles, using the profit split method is one of the acceptable methods. The third, and perhaps the most time-consuming factor, is the P&L to be tested. Taiwan Tax Authority basically prefer to use the segmented P&L of each transaction, especially for the TP audit. On the other hand, Japan tax authorities generally prefer to use the P&L at entity level. For this reason, both tax authorities will have several rounds of intense discussion on this topic for each BAPA case. Finally, Taiwan tax authorities are open to use flexible comparables. For example, if local comparables are insufficient, they may extend to a regional or even global set. In contrast, Japanese tax authority typically only accept local comparables for the tested party. Next slide, please. Since the tax treaty between Taiwan and Korea became effective in 2024, Korean multinational corporations have begun considering whether to upgrade the unilateral APA to BAPA or apply for BAPA directly. We will now share the first Taiwan-Korea BAPA case. Please see the background on the left-hand side of the slide. The Korean company KR Co. is a parent company, and its main function is distribution. The Taiwan subsidiary TW Co. purchases goods from the parent company and some from local suppliers, and then sell them in the Taiwan market through an online sales distribution model. The KR Co. provides central management, technical, and marketing support services, and their overseas subsidiary, including TW Co., uses the brand name in its sales market. To mitigate tax uncertainty and to apply consistent policy globally, KR Co. has applied for BAPA in other countries first, and TW Co. submitted its BAPA application in 2024. The tax authority have accepted the application in December 2024, and currently the application is still in progress. On the right-hand side, we highlight the difference between Taiwan and the Korea BAPA practice. Taiwan does not have a rolling back mechanism, and the cover period is kept at 5 years. As for Korea, the covered period is for 5 to 7 years, and the rollback is permissible. For the Korean applicant, the application should be submitted before the first day of the first taxable year. But for the Taiwan applicant, the application should be submitted before the last day of the first taxable year. So there is a 1 year gap between Korean and the Taiwan companies. As such, for this BAPA case, our covered period is 5 years, say from 2024 to 2028. That KR Co. using 1 year rollback to deal with this issue. The other point is the tested party P&L. Just like Japan, Korea generally accepts the aggregate approach instead of the segmented P&L in Taiwan. So that is our APA trend and the case sharing today. Back to you.
Thank you, Craig. Now, before we move to the next section on the local TP audit in Taiwan, let's do our second polling question. And the question is, for your most recent TP audit in Taiwan, if any, what kind of related party transaction are the key issues? You can have multiple answers for this question. The answers include tangible transactions, intangible like royalty charges, service transactions, or financial transaction relating to loan or guarantee, or your answer could be no, you have not encountered any TP audit so far. While our audience, choose their answers, Craig, I know this is not a covered topic today, but I believe many tax executives would want to know this. Do you see the impact of Amount B under Pillar 1 affecting TP audit, or how would Taiwan tax authorities select the audit cases?
Well, we know that Amount B applies to the baseline distribution or sales agency or commissioner function, with a pricing matrix used to determine its return. In this regard, Taiwan Tax Authority may adopt this matrix to assess the reasonable profit level that the tested party should have during the TP audit. Another point should be noted that it may be a good reference as a routine profit when conducting the profit split method.
All right, thank you, Craig. So the polling result has come out. We would say, roughly 50% are relating to tangible and intangible transactions, and then 40% related to sales, and there is minority, roughly 10% relating to financial transactions. While, there are also lucky 41% of our audience that have not encountered any TP audit before. That's very lucky. Based on our experience, almost, all company most likely will get, once TP audit, once in their lifetime. Okay, right. Craig, back to you. Our next section is your TP audit observation, right?
Yeah, thanks, Arthur. In Taiwan, there are around 20 to 30 TP audit cases every year. In recent years, cases are steadily decreasing because MOF requests district tax bureaus to deepen inspection techniques and increase the assessed tax for each case. On the other hand, MOF has expanded its revenue collection through cross-examination, covering different taxes beyond TP. As such, the audit team nowadays are more likely to conduct special tax investigation or audit related to corporate income tax, withholding tax, and the VAT on top of TP audit as well. Also, in practice, we have seen some corporations that encounter second or third round TP audit. Obviously, information contained in the master file and the country-by-country reports, CBCR, if it meets the threshold, have been widely used as a supplementary tools for the selection of TP audit and examination. Here's some new information. Currently, the National Taxation Bureau of Taipei, NTBT, and National Taxation Bureau of Northern Area, NTBNA, have respectively formed TP special audit teams to conduct TP audit. This team will also handle or participate in APA cases. Regarding the trend for TP audits in recent years, tax authorities have focused on examination of financial transactions, including related party loans and guarantee transactions. They will apply the CUFT method by using the CUFT database CUFT and make related adjustment for credit rating, country or currency difference. As for the intangibles TP, especially for the royalty transactions, the tax authority will apply the cut and or profit split method. However, the comparable profit method CPM remains common for analyzing excess profits, which means that if the tested party has higher profit, the tax authority will select a set of comparable with simple functions, calculate the total profit minus the foregoing comparables profit, and treat the residual profit as attributable to intangibles. In practice, we will call this method a CPM plus. It should be noted that with the revised TP regulations in 2020, the damping function analysis need to be conducted, and the discount cash flow DCF method could be applied for intangibles TP analysis, especially for the transfer of IP. Finally, the average additional tax amount assessed in each TP audit case has slightly increased in recent years. Note that there are only isolated cases where no tax adjustment was made when closing the TB audit. To summarize, TB audit in Taiwan has become a routine practice, and it is difficult to deal with and should be handled with due care. If there is an inappropriate or unreasonable profit allocation within a group, it's highly likely that such a company will be selected as a target for a TB audit. Next slide, please. In this page, we will continue to share the TB audit practice in Taiwan. As we mentioned before, by different types of transactions, different product categories, different counterparties, a segmented financial analysis is required, regardless of the amount involved. For separating the P&L, it is common to use the sales percentage to allocate the SG&A expenses. If enterprise plan to use other allocation keys, they should provide more supporting evidence. Another common area of scrutiny is service charge for the expatriate service provided by a Taiwan company. While a portion of the salary costs are borne by Taiwan company in order to retain social securities. In such case, an appropriate compensation for this service is required. CPM with cost plus method is a practical solution, and the typical arm's length range is relatively high. In practice, cost plus rate for this service will be 8% to 13%, depending on different service scopes. For distribution function, Taiwan tax authority are very reluctant to accept the pay ratio, even if the tax party conducts and assumes limited function and risks. Even if the pay ratio is accepted, Taiwan tax authority would expect a higher profit level in comparison to other pay ratio negotiated in other jurisdictions. An interesting point to note for M&N multinational entities is that Taiwan tax authority does not accept special factor adjustment, except when using the cap or cut method. Finally, regarding the comparable search criteria, there are several factors to consider, such as independence rating and the ratio of R&D expense or SG&A expenses to net sales for simple function. Further, there are specific requirements for the benchmarking analysis. For example, only profitable companies can be selected as comparables, especially for service providing functions. And the arm's length range could not be too widespread. Okay, that's all for the TB audit practice sharing. Back to you, Arthur.
Thank you, Craig, for sharing TP-related matters. Now, let's move on to other updates that are also relevant to multinational enterprises doing business in Taiwan. Angel, can you take us through the rest of the section, please?
Sure, Arthur. So in the following section, we will touch on a few recent domestic topics such as tax incentive updates, share transfer implications for land-rich companies, and withholding tax mitigation methods. So now I'll quickly go over some of the tax incentives updates in Taiwan. Overall, Taiwan does not have very aggressive or attractive RD incentives, but we do have some commonly used ones if you have a local entity present in Taiwan already. Please be aware that the incentives mentioned here are only available for subsidiaries, but not for branch. On this slide is the Article 10-1 of the Statute for Industrial Innovation. While this is not a new incentive, the recent update is that it expands the applicable areas of investment and increases the deduction limits. When this article was introduced, the encouraged investment areas are smart machines or 5G communication networks. To keep up with global trend, the cover activities then expanded to cybersecurity products or services. And now the latest expansion is to AI energy-saving technologies, and carbon reduction. The deduction limit is also increased from 1 billion to 1.8 billion NT dollars. This tax incentive provides current year RD credit or carry forward RD credit with the cap. Next slide, please. Another incentive worth mentioning is Article 10-2, which was enacted in 2023. The reason we brought this up was because it was tailor-made for large semiconductor players, such as TSMC, in terms of the magnitude of the qualification criteria. It does provide better RD credit rates than other articles, but only a few corporations could take advantage of this article. So this is a quick update with regard RD tax credits. As mentioned before, Taiwan does not provide a very aggressive RD credit system, but the government still promotes some industries through the introduction of new articles.
Thank you, Angel. I'm looking at the clock and I'm a little bit conscious of our time. So let's move to your next section, which will impact M&Es undergoing internal restructuring or M&A transactions relating to the taxation of transfer of Taiwan entities. Off you go, please.
Yep, no problem, Arthur. So now I'd like to touch on the recent law change regarding share transfer of land-rich companies. So in the past, direct share transfer of companies limited by shares is subject to 0.3% security transaction taxes, the STT. But generally, with no capital gain implication, as this is currently exempted under domestic laws. And for indirect share transfer, there is no STT nor capital gain implication. So this makes the reorg tax implication pretty straightforward. However, in 2021, a new rule was introduced for share transfer of land-rich companies. Under the new set of rules, for both direct and indirect share transfers, if deemed to be land-rich entities, the share transfer will be subject to capital gain, ranging from 15% to 45%, depending on the period of holding and types of tax period. Next slide, please. Now let's look at the details on what are considered as land-rich companies. There are two tests, the ownership test and the value test. If both tests are met, the shares being transferred either directly or indirectly will be subject to capital gain. So if we look at the ownership test, you look at whether an individual or a profit-seeking enterprise directly or indirectly holds more than 50% of the total numbers of the shares or the total amount of capital of a Taiwan or non-Taiwan profit-seeking enterprise. For value test, it will assess whether 50% or more of the value of such shares or capital are attributable to house and land within Taiwan. And the shares we are talking here are not listed in the Taiwan Stock Exchange or Taiwan Exchange and are not shares of emerging stock companies. Therefore, if you are considering a reorg involving Taiwan entities, please be reminded that there might be capital gain implications when involving transferring land-rich company shares. And the table on the slide shows the applicable tax rates depending on the status of the taxpayer and holding period for your reference.
Thank you, Angel. The next section is our final topic for today, which is the Taiwan withholding tax mitigation approaches. Some of these approaches are not new, so we will share some cases. And for the new ones, we will also share tested and implemented cases to demonstrate how they are applied in practice. And before we proceed, we would like to take a moment to do a third polling question today. When we designed the question, we didn't really articulate clear enough, but we meant to ask, have you applied any of the withholding tax mitigation approach on your cross-border service charges to Taiwan? The answer is, deemed profit rate under Article 25, business profit exemption under tax treaty, or Article 8, Taiwan sourcing rules, or you have never heard or applied any of the above. While we wait for the result, I'm pretty sure that most of our audience are familiar with the Taiwan withholding tax regime, but just in case some of our audience are not aware of this issue, just a quick intro. Foreign enterprise would be subject to Taiwan income tax if they earn Taiwan source income, and if they do not have a fixed place of business or business agent in Taiwan to file the income tax return for them, then the Taiwan source income will be subject to withholding tax. Now, multinational enterprises are often caught off guard for their service fee charges to Taiwan because despite service are all rendered offshore, because without any pre-approval from tax authority to confirm otherwise, together with court cases, precedents, the payer or the Taiwan client in Taiwan would take the conservative approach and treat all payment as Taiwan source income and withhold 20% tax on gross amount. Therefore, it will be beneficial for MNEs to explore mitigation approaches. So we have the polling result out. Angel, what do you think about the polling result? Are they consistent with our experience and observation?
Yes, indeed. So from the poll result, we can see that the audience here is more familiar with Article 25 and the treaty, but less familiar with Article 8. And there is a portion of audience here have never heard of the mitigation approach before. So in the next section, I will talk about the withholding tax strategy surrounding these three approaches. Next slide, please. Yes. So now let's look at the table on the slide. On the left-hand side, we have three main withholding tax mitigation approaches: the domestic Article 25, Article 8, and tax treaties. On the right-hand side, it shows the effective tax rate, which could be reduced to if qualified. So for Article 25, if the services provided by a foreign enterprise falls under one of these four categories, that is international transportation, construction, contracting, technical assistance, or leasing of machinery and equipment, the tax authority would allow the taxpayer to use the deemed profit rate at either 10% or 15%, which after multiplying the corporate income tax rate at 20% gives you the end result of 2% or 3% ETR. For treaties, if the enterprise qualifies, the tax could be fully exempted under the business profit article. But as mentioned in the beginning of the session, Taiwan only has rather limited, only 35 DTAs in place. And lastly, Article 8 also gives the taxpayer the option to use the actual profit or loss or deemed profit rate and approved domestic contribution ratio to have a lower ETR rate. Next slide, please. If we take a closer look at Article 25, the scope is not extensive, but still catches a broad breadth of services. In terms of eligibility, if it is a profit-seeking foreign enterprise, it could be eligible, and it does not matter whether this foreign enterprise has a branch in Taiwan. However, it does have some limitations, such as partnership of professional practitioners may not be qualified. We saw cases where law firm in the form of partnership would not be qualified. Also, a corporation, enterprise, institution, or organization whose head office is located in mainland China, but excluding Hong Kong and Macau, I know it's weird, but it's also not qualified. And lastly, applicants located in tax havens are also not qualified, as it is hard to prove that these entities carry out business operation in substance. And on next slide, we are listing out a few successful cases approved for Article 25 recently in the blooming industry of offshore wind industry. As Taiwan government works towards a clean energy era, wind power is one of the main focus and brings in a lot of foreign enterprises to invest in Taiwan. Therefore, we have seen a variety of companies who took advantage of Article 25 to reduce the withholding tax to 3% instead of 20%. For example, those engaged in vessel leasing, installation and testing, consultation on engineering design, just to name a few. And now we will move on to the Article 8. From the poll result, we saw the audience is not as familiar with Article 8, and I could give you the reason why in a minute. Let's start with what's Article 8. It gives the benefit to foreign enterprises with no fixed place of business or business agent of reduced ETR, just like Article 25 does. The recent changes came into place in 2019, but the Article 15 of guidance under Article 8 has actually existed since 2009. But why was this not widely used? Back then, under Article 15 of the guidance of Article 8, the rules provides the opportunity for the applicants to substantiate their cost and expenses onshore versus offshore element to calculate withholding tax on net income rather than the gross revenue, despite the foreign enterprise not having any fixed place of business to keep their books and accounting records in Taiwan. However, given the scrutiny level of the tax authority, the application in practice was only permitted after remittance of service fee. The taxpayer needs to first show the actual profit to the tax authority, and if not successful, move on to deemed profit and onshore contribution rate. And as you could imagine, it is difficult for a foreign enterprise to show the full books and records for a single project in Taiwan. And the tax authority usually requests a lot of disclosure. And thus, the experience that it took 1 to 2 years for the tax authority to finally be satisfied with that the actual profit support is hard to append, and then allows the taxpayer to negotiate a deemed profit for its corresponding industry it operates in. And normally, the taxpayer would agree on 100% domestic contribution rate, as it is hard to show the split of contribution between onshore and offshore for services provided. Therefore, because of the length of the application, which is a lot longer than Article 25, there were a few cases being submitted under Article 8. However, since 2019, under Article 15-1 of the guidance on Article 8, there has been significant improvements to the usage of this application. Now the application could be submitted in advance before the remittance of payments, and the taxpayer does not need to go through the lengthy process to prove the actual profit, but jump directly to deemed profit rate negotiation and onshore contribution rate. Under the new provision, the process is shortened significantly to less than 6 months. So we are now seeing more taxpayers choosing Article 8 as their withholding tax mitigation approach. And now let me show you example of recent Article 8 successful cases. The first one is with a Danish law firm, which is seeking to reduce the withholding tax on its consultation to Taiwan clients. However, as the form of the Danish law firm is a partnership, it is unable to leverage Article 25. However, just like other international law firms, they also have their consulting company, so the contracting entity can be solved. However, the legal services are not considered as technical service in the Article 25 assessment guideline, as the service nature are considered routine or managerial in nature. So even the contracting entity is changed from the partnership to the consulting company, there's still a certain level of risk that the application could be denied under Article 25. Therefore, we assisted the client in reviewing their service agreement using their consulting company. And with the new Article 8 and no restriction in the nature of activities, it is able to claim deemed profit rate of 21% in the industry under the category of other management consultation, and thus gives a result of effective tax rate at 4.2%. Another case is with a Hong Kong headquarter applicant. Though under Article 25, it does allow Hong Kong enterprise to apply. This entity provides management services more aligned with backup services, and therefore Article 25 may not be granted as it does not fall under the technical assistance category. Therefore, the applicant decided to go with Article A, which it does not restrict the service category. And in the end, under the other management consultation service category, the deemed profit rate of 21% also obtained with the end tax result of 4.2% for this applicant. So from these two examples, it is apparent that Article A does give clients an alternative option, where Article 25 is not feasible and still gives a relatively low effective tax rate in comparison to the default withholding tax rate of 20%. And the time needed to obtain the approval is significantly reduced comparing with the previous approach under Article A. So please keep in mind that there is now an additional option to consider when looking to reduce the withholding tax. And now I'll move on recent treaty cases for your reference. As we all know, in order to enjoy treaty exemption, foreign enterprises should not trigger PE in Taiwan. And depending on the country we have a treaty with, we usually look at 183 days as a rule of thumb. With this vessel leasing case from a Dutch lessor, we successfully obtained the treaty approval despite the vessel rental period is way beyond 183 days. So in this lease agreement, the vessel being leased is classified as time charter light. The uniqueness of this is that the owner of the vessel is merely leasing the vessel, while the management and guidance of the crew is the responsibility of the lessee. Under the OECD commentary on Article 5, it states that the mere leasing does not constitute a PE, even with supply of personnel, as long as the personnel in the operation or maintenance of the equipment is under the direction, responsibility, and control of the lessee. So we share this case as this does create a precedent when we see a new form of service in the new industry, and as new players enter the Taiwan market, Taiwan Tax Authority can also learn the latest development in the application of the OECD guidance. Another case we would like to share involves a foreign enterprise with a Taiwan branch. So usually with a Taiwan branch, a PE in Taiwan, it seems that the possibility of applying treaty benefit is low, especially under the Taiwan domestic rule, where there is a force of attraction rule, where the Taiwan branch is obligated to issue Taiwan VAT invoice and report corporate income tax on behalf of its headquarters when the headquarters is rendering services to a Taiwan client directly, even though the Taiwan branch is not involved at all. And let's look at the client fact pattern here. This Japanese client has a Taiwan branch with history of helping its Japanese headquarters to do local communication and marketing for local clients and earn service commission income. However, for a particular special product line, the Japanese headquarters is directly in contact with the Taiwan client and uses an external third-party warehouse to transport and store such products. Based on domestic rules, storage of inventory in Taiwan would be considered as PE without treaty protection. Although the Taiwan branch does not involve in any matter of this special product line other than the local communication, for indirect tax purposes, the Taiwan branch registers itself as a business agent and issues the Taiwan version of VAT invoice on behalf of the Japanese headquarters, as well as reported Japanese headquarters income and paid income taxes based on local rules. And in this case, we successfully explained the fact pattern with the evidence to demonstrate that headquarters sales to this special Taiwan client is in a different sector from which the Taiwan branch usually operates, coupled with the support of business reasons such as need from this special Taiwan client, different currency charge, and Taiwan branch's role being limited to solely liaison and communication with arm's length fees. Therefore, the treaty approval was obtained. This means that the Japanese headquarters business profits earned from this Taiwan client are exempt from Taiwan income taxes. So this case shows that even with the PE in Taiwan, it may not be the end of the world for the foreign enterprise, and it could still be assessed and substantiated for treaty exemption. To sum up, we have shared three main approaches to reduce withholding tax in our recent cases. If we take a snapshot, you will see that in terms of the application duration, Article 25 takes the shortest time and the treaty is the longest. However, treaty does give the best tax outcome, while Article 25 and Article 8 gives a relatively low tax outcome. If you look at the pros and cons on this chart, it will give you a good starting point when assessing the most preferred way to reduce withholding taxes. The last thing I would like to highlight is that if the approval obtained covers the period where the payments were already made, the refund application is possible. The good news with the refund period is that in the past, it is only 5 years, but now it gets extended to 10 years for Article 25 and Article 8, and most recently, extends to treaty under a proposed amendment in January, unless the treaty regulates otherwise. And here concludes my sharing for today, and I'll pass back to Arthur for the final remarks.
Right. Thank you, Angel and Craig, for your sharing today. It's time for questions and answers. I do have one question from the audience. Will the increased AMT rate apply to gains realized by the Taiwanese companies on disposal of subsidiaries where the share are securities and the subsidiary is not land rich? Well, this increased AMT rate will only hit multinational enterprises that got caught on the Pillar 2. So that means, first of all, your global revenue has to exceed 750 million euro to start with in order to get caught under this increased AMT rate. Second of all, if it's not land-rich subsidiary, this AMT can be easily mitigated as long as the seller or the shareholder does not have a fixed place of business or business agent in Taiwan, because AMT would only apply to foreign enterprises if they have a fixed place or business agent in Taiwan. So that's the first question for our audience. The second question I see here is, I think this one is for you, Angel. In one of the article application cases regarding the law firm, is it mandatory that it has to be a company rather than partnership? So partnership is not eligible, and why not treaty? Because apparently from the slide earlier, Taiwan and Denmark has a tax treaty. Angel, can you take this?
Yes, sure. So the rules under Article 8 do not exclude partnership. It only says foreign profit-seeking enterprise. So we did solicit views from tax officers in different districts on an anonymous basis. Some tax officers are open to this, and some are conservative, indicating that a partnership is not eligible for Article 8. Therefore, in that case, we took the conservative approach and recommended the client to use their consulting arm to sign the contract with the Taiwan client. As to the treaty, yes, Taiwan and Denmark does have a treaty, but sometimes the client would look at how urgent they want the cash. So even though the treaty does give a better tax result, but it also takes the longest in terms of the application. So after evaluating the pros and cons, in that case, the client decided to go with the treaty.
All right. I have another question from the audience. I think this one is for you, Greg. What is the TP audit split ratio percentage between local enterprises and multinational enterprises in Taiwan, and any sectors that Taiwan Tax Authority prefer to exempt or do the TP audit? Craig?
Yeah.
Could you please?
Well, yeah, sure, Arthur. Based on our internal database, generally speaking, multinational entities in Taiwan count around 30% of the TP audit each year. And the sector varies, with the top 3 targets is electronic components, computer and peripheral equipment, and electronic machinery industries, Back to you.
Okay, thank you, Craig. We have another question. Will there be any drawback and afterward checking after obtaining Article 8 approval? I'm not sure what that question means, but basically, once you get the approval for Article 8, I believe that you can apply. Usually, the tax authority will give you certain, eligibility for cover period. So let's say 3 years, and after 3 years, if you want to continue to, apply, this deemed profit rate under Article 8, similar to Article 25, you have to submit the application again. So that tax authority can assess whether your fact pattern has changed, whether you are still operating in the same business activities, and whether the deemed profit rate for that industry code still appropriate, and any update on the profit rate published by the Ministry of Finance. So that will be my answer to that question. And so I think that's we still have more questions, so we will try to cover it afterward. And that's unfortunately is all we have time for today. Thank you to you all for who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily, and tell us what you think about today's program. If you join us late, please know that this presentation will be archived for future viewing. If you feel that others will benefit from this webcast, please share the webcast via share this icon, or have them visit Dbriefs website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think any other questions or comment later, please feel free to reach out to either me or our speakers. We would be more than happy to talk to you. And please tune in to our next Dbriefs webcast, Tax Transparency Unveiled, First Experience with EU Public CBCR and Implication for Asia Pacific, on 20 February at 2:30 p.m. SGT. Lastly, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.